So, good afternoon, everybody. I'm Hannah from the Bangor Public Library. I just wanted to give a quick welcome and thank everyone for being here. This is another and a continuing series of programs that we do in partnership with SCORE Northern Maine on different subjects related to folks who are entrepreneurs and small business owners. Today we've got Nicole Morgan, who we're very excited to have. I'm going to hand things over to Donna from SCORE to share a little bit more about what SCORE does and about what Nicole's going to be speaking about today.
Perfect. Thanks, Hannah. Well, welcome to everybody. SCORE, if you've not heard of us, is an entirely volunteer organization. We have about 130 mentors in the state of Maine, and we're able to help people from the idea stage. I have an idea of a business I want, to people who are in business, to people who are ready to sell their business. So if you at all would like help on your journey, just go to score.org and ask for a mentor. And then we will match you up with someone that we think can be most helpful to you. And with 130 mentors, there's really great opportunities. We often have multiple mentors, depending on what people are interested in learning. So that welcome any of you to sign up for our mentoring help. Would like to introduce Nicole Morgan. Nicole is not only the Assistant Vice President of Bangor Savings, but also was a SCORE mentor. So Nicole has strong roots in the community. She really understands the loan part of the business, and she also has had good experience working with entrepreneurs. So delighted to have Nicole here with us, because I know as I mentor, the minute you start talking about a bank loan, people's eyes get terrified and want to figure out how they can best help themselves to get a bank loan. So with that, Nicole, I'll turn it over to you.
Thank you so much, Donna. Thank you, Hannah, for having me. I'm going to actually apologize. I am getting over the crud, so I may have to mute occasionally so you don't have to listen to me hack up along. But I do want to thank you guys for joining me today. As Donna said, my name's Nicole Morgan. I am what we call a Main Street Senior Relationship Manager for Bangor Savings Bank. I'm also an instructor for the College of Business at Hassan University. So to say that small business is a big part of what I do every day would be a massive understatement. So first things first, I do hate when people use jargon, so I'm going to try really hard not to do that. I'm going to expect you guys to call me on it if there are terms or phrases or things that I'm using in this presentation that just don't make sense. Hannah will flag me down and say, hey, people are wondering what the heck you're talking about. So with that said, I'm going to start by defining the term Main Street. Main Street is a commonly used term in the banking world, and it refers to our small businesses. So if you picture your town and you're walking down your main street, those businesses are going to be your favorite bakery, your laundromat, maybe a pet store, sandwich shop, a tax accountant, your optometrist. Main Street is going to assist all of these customers with all aspects of their financial needs. And my job is to partner with them to ensure they have everything they need to be successful. So most people start a small business because they have a thing they're really passionate about, like baking cakes, for example. And they're really great at baking those cakes. And they're so great, in fact, that people tell them, you should do this for a living. So they say, hey, yeah, I'm going to do this for a living. It doesn't take very long after that euphoric period for you to realize that it takes a lot more to own and operate a business than just being great at baking cakes. So what we're going to cover in today's session is a really important part of that process, and it's applying for a bank loan. And also, bear with me as I'm switching multiple screens here and perfect. So you've gone through the process, you have your idea, and now you think you need funding. This is the typical process for every small business owner. So when you are considering starting a small business, you really need to go in with eyes wide open. It is not for the faint of heart. The SBA actually shares some potentially alarming statistics that include the fact that 90% of startup businesses don't make it. And you would think this might be specific to certain industries, but it's pretty static across all industries. And the statistics get a little bit better as you continue on in your business cycle. But one of the second largest reasons why they fail is lack of money. So another statistic, 1 in 4 businesses surveyed by the SBA, they weren't able to receive the funding that they needed. And they felt like that limited their growth of their business and ultimately could have contributed to their not being successful long term. So this is a very big deal. It's a very big topic for us to be talking about. And as you can imagine, before you go to the bank or even an investor, I'm going to sort of use those two terms interchangeably through this talk because some of you may have investors that you are approaching for financing, and I want you to be prepared for either situation. But before you ask anybody to borrow money to support your dream, you really want to make sure you're positioning yourself to be the best loan customer possible. So to do that, you really have to be prepared to put some work in. I should have had somebody else changing my slides for me. So our agenda for today, I really wanted to make sure our time was going to be as valuable as possible. So I thought about what are the things that come up when I'm meeting with a customer and they think they're ready for a loan application. And what I've actually found is it's not the physical process of filling out the business loan app that causes customers the most angst. It's really understanding of what's being asked of you to prepare for that application. So today I'm going to talk about 5 different steps I ask my customers to take in order to be best prepared to apply for financing. And I do want to put in the disclaimer, these are specifically what I use in my professional role to ask a customer to be prepared for financing, but you can expect that these are pretty standard across the board. Any person or institution interested in risking their money to support your endeavors are going to have similar guidelines in place. These guidelines really help ensure the safety of our investment, but they're also a really important exercise for you as a business owner to ensure the future success of your idea. So those 5 steps, we're going to start by determining your business status. Are you a true startup, or is a lender going to consider you a seasoned and established business? So you remember that statistic I shared with you a few minutes ago regarding the failure of businesses. It stands to reason that the work that a new business is going to have to put into this process is quite a bit more than a business that already has established and consistent profits. I'm going to ask you to know your business. So you already know your business inside and out, but oftentimes one of the hardest parts to this process is taking all of that knowledge out of your head and putting it down on paper so a potential financer can really understand it and ultimately get behind it. I'm going to ask you to know your ask. I think I need $50,000 is not a good ask. So a responsible borrower should really be able to account for the need and purpose of each and every dollar of not only their own money, but a lender's money as well. Excuse me. I'm going to ask you to know what your business is worth. So pay really close attention to your financials. Spend some time putting together projections. How long until you will turn a profit? Or once you factor in your expenses, are you going to turn a profit at all? I'm going to share some tools that are going to help you with this important piece as well. And last, it's very important that you know your personal credit. So there's a common misconception that business loans are based on business credit. And I'm here to say I'm sorry, but that's not the case. So we're going to discuss why your credit matters and how to make sure it's in tip-top shape for your lender. And between you, me, and the lamppost, I have not practiced this presentation with a timer, so I am hoping we have some time left for questions. If not, Hannah and I have talked about ways that you can get in touch with me so that we can make sure you get all your questions answered after. So, first things first. Is my business established or am I a startup? So jumping right into determining this, an established business has essentially weathered some of the storm. They may not have turned a profit yet, or they may not have turned a large profit, but they've seen some ups and downs. they're into their business cycle, and they've demonstrated at least a certain amount of business acumen to remain afloat. So in banking, we demonstrate that by having at least 2 years of tax returns, and the request should be to support something in your same business industry. So for example, a bakery looking to purchase another bakery would be considered an expansion of an existing business, and therefore probably not putting you in a startup category. A startup is anyone less than 10 years old, or 2 years old, excuse me. Or you are expanding outside of your typical industry. So our friends with the bakery have decided, I want to buy a doggy daycare. They're likely going to be treated as a startup, and therefore they're going to be subject to those more stringent requirements for financing that project. So I'm going to pause for what I think is a pretty common question when we get to this point regarding corporations and tax returns. So let's say you've been a sole proprietor and you file your tax returns with your Schedule C. So your business income is shown on your personal taxes, but you've recently said, I really need to protect myself. I'm going to start an LLC. Are you considered an established business, or are you considered a new business? And the short answer is it really depends. And that's something that you would want to talk with your financer about. So whether that's your lender or your investor, more than likely, it's just a change in your filing status and your experience and your historical income in the business is going to keep you kind of in that experience. But again, that's a question that I would ask your lender. So ultimately, we start with this because understanding where you're at in your business cycle is going to help you be best positioned for a loan request, and that's why we started here. So knowing your business, lucky for you, this is both the easiest and the hardest part. For everyone who's passionate about something, it can sometimes be really difficult to articulate that something to others who don't share your passion. So while you're bankers, we're on your team. We're likely not going to be experts in whatever your business is. So I am not an expert in the perfect buttercream frosting. I would be happy to be your taste tester, but I don't understand your margins and I don't understand your customer base. So it's really important for you to share all the details with them that only you as the business owner or the business idea, only you're going to know these things. So this can really feel like a daunting, but it's actually leading to a really common term called a business plan. So while each business is unique, business plans really do have tried and true information that help you to communicate the value of your business, how you plan to make it work, and why this is a business that is going to make money. Examples that you would find in a common business plan: who is my customer? Who is my competitor? Am I seasonal? Etc. If you're not sure how to approach this task or even where to start, lucky for you, we actually have lots of free resources available to assist you with as much hand-holding or as little hand-holding as you feel you need where you're at in your process. If you are willing to go it alone and you just kind of want to tackle this, the SCORE website is packed full of useful information. There are classes, webinars, there are articles, there's even templates. So you can just plug and play your information right into these templates. If you feel like I need a little bit more hand-holding, SCORE Maine actually offers those free mentoring services that Donna talked about. So this is probably one of the biggest requests we get as SCORE mentors is help me with my business plan. Mentors are experienced volunteer professionals, and they are really available to help at all different stages of your business growth, including starting that business plan. So I've talked with Hannah. We're going to make sure that those links are available to you at the end of this presentation. So if you do have questions or if you're interested in moving forward with something like that, we'll make sure we get you those tools. They're free. And I really strongly encourage anyone interested in starting a business to at least explore it, even if you think you've got a handle on things. You'd be surprised what you may uncover when you start doing the digging, and you'd rather uncover it now. All right, so understanding how much money you need kind of sounds like a no-brainer, but this is often the question that customers and business owners find themselves stumped to answer. And there really are no magic tricks to how to determine this. The best thing to do is really just put pen to paper and write out everything you're hoping to accomplish. Then write out how much you think it's going to cost to do these things. Then finally, determine how much of that you are willing and able to contribute from your own pocket. This process is going to turn into a document called a sources and uses table, and it will ultimately end up in your business plan. So to help illustrate what I'm talking about, I actually went and grabbed a visual aid from the SBA website, and had I had more time, I would have probably found one a little bit less complicated. So I do want to preface this by saying this is a big loan request on this sources and uses table. Yours is very unlikely to look like this as far as dollar amount, but it is a really good example of a deal that needed lots of different creative solutions to get to fruition. So I like this example for that reason. But again, I just, I want you to know, I know we're not dealing with $6 million loan requests in a lot of startup cases. So if we look at the sources side first, we can think of sources as where is all this money coming from? So in this particular case, the borrower is contributing $370,094 of their own money. But the ultimate amount needed to achieve this project is 5.7 million. So their 370,000 is not enough. Now, most banks are not going to finance more than 80% of your project. So you have to figure out, how am I going to fill that gap? So the next thing you see on that sources is they have a really nice father who said, I'm going to give you $200,000 to buy this doggy daycare. So they have got this listed on their sources as a documented gift of funds. But that's still not enough. So that's only 3.5%. So they're up to about 10% of their financing need. So the next thing you'll see on there is what we call a seller's note. And I don't want to get too into the weeds, but a seller's note is an arrangement where essentially a seller will lend you the money and you pay them directly. And a lot of times a bank will look at this as also money that you've contributed because you're going to be paying that debt. So if you look at the bottom, the SBA loan makes up the total difference needed to fund this project. Then we're going to move over to the uses, which is where we see how that money is being used. So in this case, they're using $2 million to purchase the business. So business acquisition is probably they're buying a name, they're buying customers, they might be buying inventory or accounts receivable. But essentially, it's everything but the real estate. Because then we look underneath and we see they're actually buying the real estate as well. So 3 million of the funds on the sources side is going to be to purchase the real estate. Then they want to have some extra money on hand just in case. So that's your working capital. That's your money that sits there. I need to buy supplies. I need to have money to pay bills. Just money that I have sitting here. And then you can see they're looking to finance their fees. So again, this is a complicated structure, but it's a good example of showing you, here's all the different places I'm going to get money, and here's all the different places I'm going to be spending that money. So a lender or an investor is going to want to know that their money is safe with you. So everything we've covered so far is helping you to paint that picture. but a good idea is also only a good bet if it makes money. So this is where you will show that all that work you've put into your business plan and my sources and uses, all of this is going to help me make enough money to at least pay my loan payment each month, hopefully with a little bit of a cushion. So most banks are looking for the project needs to generate enough money to pay for itself, but we want to see that you're turning just a smidge of profit to build that just in case cushion. So for a business that's already up and running, you show this by providing us your tax returns. Profit and loss statements and balance sheets are also something that a bank will likely ask for to show what your expenses look like in comparison to your revenue. For a new business, the work goes into creating projected financials and corresponding assumptions. So this is another one of those jargon moments. What are assumptions? Assumptions are basically the reason your projections are real. So for example, an expense that I would expect to see listed on your projections is insurance. You're going to have to buy insurance for your building or liability insurance for your business. The assumption that backs up that projection is a quote from your local agent. So why is this expense a real dollar figure? Well, I talked to my agent and this is what they gave me for a quote. So we're going to look a little bit. Okay, just kidding. Well, my slide shows projections and yours doesn't. So I'm not sure. Hang on just a second. Pause. I apologize. I don't know why the one that I'm using for a visual shows it and this one does not, but I do think this is important and I want to share it with you. So hang on 1 second, please. Hannah, maybe now is a good time to see if there are any questions that are easy to.
Sure. I haven't seen anything coming through the chat yet, but if folks do have questions you want to
Can I
type
ask
in
a
right
question real
now.
quick? Oh,
Yeah.
sorry. I'll just
Go ahead.
I'm typing.
That's fine.
There was something that was on there that a number I didn't really understand. It said the SBA guarantee fee. That was like 175,000 something. Did you touch on that a little bit?
Yeah, so that's a great question. So sometimes with a startup, a bank is going to say, yes, we really want to be your lender, but we are not sure that we are willing to take 100% of the risk. So we will work with the SBA to say the SBA will guarantee your loan in case for whatever reason your business doesn't succeed. That fee is more than likely not something you're going to run into with a smaller loan. It's a large fee because that's a large loan deal.
Okay, so that's usually how this works. If you go through like the SBA getting loans in with them, it's like we kind of work with you guys and they guarantee it for us. So you're more likely to give us the loan, right?
Yeah. So certain banks are considered SBA preferred lenders or have a relationship with the SBA. So we will be your lender and we will use the SBA to make sure that you're protected from a guarantee standpoint.
Okay, thank you.
That's a good question. Thank you for asking. So I'm hoping you all can see a spreadsheet on here.
Yeah, it's a little small,
perfect.
so I don't know if you can zoom in on it at all, but we are seeing it.
Yeah, I had it all clipped out. It was nice and clean, but no good plans. How's that? Is that a little bit better?
Yeah, that's looking better.
Okay. So this is a template that I use with customers and it helps customers to think about all the different ways they will be spending their money in order to run their business. So if you look at the top line items under income, we're looking at what your revenue is. And I have mine broken out by month because I think it's an important factor for you to think about. In some months, I might be really, really busy. And in other months, I might have slower revenue coming in. And I think it's important for you to sort of go through the exercise of checking things month by month. On the bottom are just some really common expenses you can expect to pay. This is absolutely not all inclusive of every expense as a small business owner. And this is just one template available. But you have salaries and wages if you're planning on taking pay out of the business. Maybe you're not, or maybe you have to hire someone to help you. These are expenses you're going to want to consider on day one. Repairs and maintenance, taxes and licenses, advertising, supplies, insurance, telephones, utilities, and other. Again, this is not an exhaustive list, but I would encourage you to think about all the different ways you may need to spend money in order to operate your business, and make sure you're accounting for that. We really could spend a great deal of time on projections, but in the interest of keeping us on time, I am again going to encourage you to check out the SCORE website. They have multiple templates. Some are specific to certain industries. So hospitality has a template, retail has a template. And so you'll expect that those expenses are kind of in correlation with those different industries and what you can expect to have for expenses. And also, if you get stuck, that again, SCORE mentors, you'll hear me make plug after plug for the SCORE mentoring services, and that's because they're such a wealth of knowledge that we'd be silly not to be using them. All right, I think I'm back on track here. Excuse me. So, as we talked about earlier, there is a common misconception that businesses generate their own credit score. Well, that may be true for very large businesses dealing with very large banks. The likelihood is that your business's creditworthiness is going to be based in large part on your own personal credit. So what does that mean for you? First and foremost, and I cannot say this with enough emphasis, you need to know your score. We are fortunate to live in a day and age where knowing your credit score, it's not a challenge anymore. Most credit cards come with some sort of credit scoring program. There are also multiple legitimate credit monitoring services available. Some you pay for, others you don't. I'm not sure if I'm allowed to plug my favorites, but you'd have some good karma if you were to look up some of those monitoring services. If you're picking up what I'm putting down there. Honestly, monitoring your credit is a baseline expectation for being a good business owner and frankly, a responsible consumer. So one of the very first conversations that I have when a customer sits in front of me and wants to talk business financing, I want to know that you understand your personal credit score. If you do not, it is very unlikely that we're going to move much further in the conversation until you've taken certain steps to make sure you do. And that's in part because I have to know it in order to get you to closing and to get you funded. But it's also in part because I need to understand that you are monitoring all aspects of your financial health, not just your bakery, but that all the other bills are getting paid as well. So I did not want to assume that everybody has credit score conversations every single day like I do. So I wanted to share this visual with you. Each bank has sort of our own criteria for scores and what we look for in a credit score. But I did want to share this chart with you. It's provided by Experian, which is one of the credit bureaus. And in general, you should try to be above a 670. Now, all of those credit monitoring services that we talked about, they use some different models. So what you see for a score may not be what your bank sees for a score. But again, I tell people, look at the bucket you're in. As long as your bucket says good, then you're probably going to see a credit score that is reflective of that. I also want to acknowledge credit scoring is not a perfect system, but it really still is the best indicator that we have available to us on how someone handles debts and payments. And whether we like it or not, it is the system that we use. So then also understanding your personal credit is understanding your debt to income ratio. So this is a mathematical calculation that's all of your monthly debt payments divided by your gross monthly income. And this is another indicator that lenders use to measure your ability to manage your monthly payments and to make sure that you have the ability to repay money that you plan to borrow. So, another helpful visual for us. So if you have, let's say, $5,000 in monthly income and $2,000 in monthly debts, your debt to income ratio is going to be roughly 40%. And again, every bank is a little bit different, but this is probably pretty close to the figure that a bank is going to look for, excuse me, for a good borrower. So I think I'm reading your mind and you're thinking that is a really, really low number. What am I doing with the rest of my money? I still have 60% of my money available to spend. Remember that income is gross. So it does not include all of the deductions that you likely have taken out before you get your check. So I would encourage you to do the same calculation with your net income. So take all of your deductions out, and the actual money that's deposited at the end of the day, when you get that paycheck, run that ratio. And you're going to see it's pretty significantly increased, meaning the percentage of leftover funds is going to be much, much smaller. Eek. All right. Okay, and last but certainly not least, I just want to touch on understanding personal guarantee. So as a small business owner, the success of your business sits on your shoulders. So most banks want to ensure you have, for lack of a better term, skin in the game. So they're going to ask for your willingness to personally guarantee a loan, which basically means if something were to happen, let's say this business idea, it's just not for you, or something else occurs and you have to close down or dissolve the business, they're still going to look for you to personally repay the loan. So this is a pretty standard requirement and something that I think is really important to understand your obligation as you're entering into a request for financing. I back all the way up to one of the very first things I said, you need to go in with eyes wide open. So this personal guarantee is one way that you do that. This is your debt. This is not I Make Cakes LLC's debt. This is John Smith's debt. So my timing was pretty good. So as you can see, the process for preparing to do a loan application really has so much less to do with the application itself. And it's really much more into the preparation that you put into it. So if you take all of those steps that we discussed today, you're going to find the application is going to be pretty slick. It's going to be a much easier process for you. But also, and probably most importantly, you're going to have a better understanding of your business, where you are at financially and where you are going. So I hope you guys found this helpful. And that helped to demystify some of the business loan application process. I do want to share seminars like this, really just the tip of the iceberg. As you can imagine, we probably could have broken down any one of those 5 topics and spent a significant amount of time going into it. But we did not have that kind of time today. So the state of Maine, we really have a vibrant startup culture, and it's in part due to resources not just like this, but other programs that we have to support our entrepreneurial culture. So if you're looking for more information on those resources, hey, I haven't mentioned SCORE in a while. How about you check out SCORE? So there are 2 websites, and again, we'll make sure you get access to that information. SCORE, the national chapter of SCORE has stuff that's sort of general business stuff, and other financing opportunities are available. And then SCORE Maine has stuff that is really focused on supporting our Maine businesses and our Maine economic climate. But they're 2 really, really good places to start. So I really feel that with all of these tools available to you, you will have no problem positioning yourself as your banker's favorite business owner.
Thanks, Nicole. We do have some questions in the chat, so I'm happy to lob those your way and see how you do with them.
Sure.
Okay, so we had a question. Does change of ownership of an existing business require both historical data and projections for the business under new leadership?
That is an excellent question. Yes. So change of ownership. Oh, well, short answer is yes. And then I'm going to talk for a while. So change of ownership is considered a material change to a business, right? Because whatever the business is doing right now is under one specific person's leadership. So somebody else stepping into that seat could mean changes. This new person may have not as much experience, or maybe they have more experience. Maybe they have ideas for how they would like to change things. So what we would look at from a financing perspective is we want to see everything the business has been able to achieve. So we do that by looking at the business's tax returns. But I want to see what you're going to do with it. So Hannah, as you take over this bakery, I want to know, okay, you have ideas, you want to add a delivery service and deliver cupcakes to the Old Town branch of Bangor Savings Bank. What is that going to do to those figures, those historical figures? So you sort of straddle both worlds where you've got the support of being an established business, but you still have all the work ahead of you of pretending you're a startup. It's a great question.
I'd better learn to bake first, but
I'll wait for those cupcakes.
Yeah. The next question was, what about some gap financing through organizations like Community Concepts and or CEI? How often does that happen? And can it be used to close that 20% remaining? I think that was referring to that first table you showed.
Yeah, so in that sources and uses, you could very easily have slid gap financing into any one of those items. A bank is going to look for you to put something down. As a personal borrower, I'm going to look for you to have something to contribute. Now, how much that something is between you and I to discuss as we're looking at the deal. But one way that I often will get a deal done is by filling that. Let's say you've got 10%. And we don't know where to get that extra 10% from. You don't have any rich family members. Nobody's banging on your door to gift you that remaining 10%. I'm going to call my partners at CEI, at EMDC, at NMDC, and I'm going to say we need a 10% gap financing loan. Very, very common and a very important partnership that we have to make sure we're getting things done for customers who may not have. You may not have that extra 10% hanging around.
Right. Yeah, Eric just pointed out SBDC has great financial forecast Excel sheet that's available upon request and sent the link out to that. So that's another good resource if you're trying to do that piece of it. And then Frank asks, please discuss application for business LOC.
I guess, Frank, I'm going to ask you to clarify your question.
And if it's easier, Frank, feel free to unmute yourself and speak up, or you can type more in the chat.
Yeah, sure. I'll speak up. Can you hear me?
Yes.
Okay. Is there a difference in applying for a line of credit than a low conventional starting a business or whatever? And discuss the role of the line of credit in operating the business.
Yeah, it's a big question. So from a financing perspective, there's no one size fits all structure. So not every customer should have a line of credit. And not every customer needs term debt. It really depends on what their financial goals are, what they're trying to achieve, and really what their industry looks like. Some industries lend themselves to a line of credit being a appropriate solution, and some do not. So it's difficult to answer that question. I think the physical process still, I would still direct you to the 5 steps to prepare for that application, as far as understanding your business, understanding your financials, understanding your credit. Where you might be looking for support is on that know your ask. So I don't exactly know what I need for a structure. I know I need this much money. And that's a conversation that you would have with your lender. A good seasoned lender knows that you may come in and sit down and say, I need a $10,000 line of credit. But when they ask good questions, they dig deeper, they really get to know you and your business. They might say, actually, I think what you really need is some permanent working capital, not necessarily a line of credit. So that's one of those conversations that I would recommend having with the lender after you've sort of got all the other pieces ready for them. Hopefully, does that answer your question, Frank?
Yes, thank you.
Okay, excellent.
Right. That's what we've got in the chat so far. If there are folks who have more questions who'd prefer to ask them verbally, go ahead and speak up and we'll try to make sure it's not a crazy
Yeah, I'm gonna
overlap.
speak up.
Go
I'm
ahead.
just on a tablet. It'd take forever for me to type it in with my finger.
For sure, go for it.
So with the when it was saying the personal guarantee for the loan after, right? Like what we're putting up collateral. Are you able to, does the SBA help with that for that guarantee part, or is it like you're putting your house up on it? Does that make sense?
So yeah, great question. Thank you for asking, because I want to clarify. The guarantee doesn't necessarily have anything to do with collateral. So collateral is how the bank secures your loan. So if you're buying a truck, the truck is the collateral. If you're using it to buy inventory, the inventory is collateral. So that's kind of its own separate thing. And I didn't really get into it because it's specific to each deal, really. How we put collateral together for a loan is specific to each deal. Your personal guarantee is, it's not collateralized, but it is saying I am going to pay this debt. So if I dissolve my corporation or I shutter my doors tomorrow, I'm not selling any more cupcakes, I am still going to make sure this debt gets paid out of my personal income, not out of the revenue for the business.
Okay. And can I add one more little question to that?
Sure.
Let's say there's multiple people that are going in on a business venture.
Yeah.
Is the business loan, from your guys' point of view, is it better to have, let's say there's 4 of us. Is it better to have 4 of our names on that loan going into this over say just 1 or 2 people doing the actual business loan themselves?
Yeah, that's another really good question. So I'm going to speak to my experience as a lender, and I'm just going to tell you that other banks may have slightly different criteria, but I assume our metrics are kind of across the board. So most banks sort of use very similar ways of looking at ownership. So if you are, let's say there are 4 of you who are going into business together and you're all going to be on the LLC and you all have 25% ownership, so equal ownership across the board. I would require that everybody who has 25% ownership is personally guaranteeing the loan, because you all have equal stock in the success of whatever that business endeavor is.
Yep.
So everybody would need to be a guarantor.
Okay, on the loan. So I just
Correct.
meant, like, from your guys' side, it looks better for you guys seeing more people investing into the loan than less people into it, right?
Not necessarily. So if I'm looking at a loan deal and there are 4 people who are equally committed to whatever this business is, then yeah, I want to see all 4 of you investing into the success of it.
Yep.
I'm just now thinking I'm hearing your question. Are you talking about like financial contribution? Like each of you needs to
Yeah. Like, let's say,
Okay.
like, right off the bat, like, are you guys looking at, hey, is it just like, say, me as vet going in and getting that like guarantee loan on one person so that the weight's on their shoulder? Or from a bank's point of view, are they like, nah, we like that there's 4 people coming in here, because then that gets spread on 4 people to pay the loan, you know?
Yeah, it's not really material to the request. What I'm going to be looking at is that everybody is a good, strong guarantor, that they belong there. As far as like, they're committed to your success. They're not just some random cousin with a good credit score, that they are somebody who's at least invested enough in the business that it makes sense for them to be putting their name on it as a guarantor.
Yeah, I like what you're saying, because that actually kind of is answering my question. If there's 4 of us that want to go in on the business, I was already thinking, hey, all of us come up with our way for 10,000 in, that's your guarantee thing, and then you go get the loan. So you're making it sound that's exactly what we should be doing. So, okay.
Okay, perfect.
Have any other questions at the moment? Folks want to unmute and speak up?
The only comment I might have is that I know when I work with people on business projections, that can be the toughest part because you're predicting, you know, how much income you're going to have. So really would encourage you to, there's resources out there, some of them, for example, at the library and about, you know, what is a common return on it on a specific type of businesses. Some businesses might be 50%, some might be 10%. What are typical expenses? And so kind of doing your homework around your projections to make sure that when you go to Nicole or some other banker that you haven't just kind of pulled the numbers out, but you can say, well, you know, my cousin has a beauty shop down in Portland and 25% of her costs are, you know, hair color and supplies and things like that. So I think it's really, really important to know your competition, have discussions, and you'll end up with a better projection in terms of your income, and it will make the process go by smoother.
Yeah, that's a really good point, Donna, and I appreciate you highlighting that. SBDC, somebody had mentioned, is another resource, and I will often send customers to SBDC for assistance with creating projections, in part because they have compiled a really comprehensive database of that type of information. So what are the margins on pizza shops, and what are the margins on barber shops and clothing stores, and it's regional data. So they try to be as current and relevant as possible. So if you don't know where to start with finding that information, they can say, oh, well, this is how much money that you're going to spend typically on inventory, and this is how much money typically you spend on supplies. So it's I mean, we really are very fortunate, particularly in this area of Maine, to have access to the resources we have.
Nicole, this is Tom Moore. I just want to say thank you for sharing your experiences with us. I have a question about the difference in interest rate from an SBA to a commercial loan from Bangor Savings. Is the SBA loan, would I expect that to be higher than the bank loan in terms of an interest rate? And what is that penalty?
Yeah, that's a really good question. No. So our interest rates, so again, I'm speaking a little bit specific to my role, and I apologize if that's going a little bit off track, but I do want to address the question. So my pricing is Bangor Savings Bank pricing, not SBA pricing. So the penalty, so to speak, used to be that sometimes there would be an SBA guarantee fee, but that's very deal specific. So sometimes there is a fee associated with using an SBA guarantee, and sometimes there is not. There's a lot of factors that go into that, the size of the loan being one of them. So I would say from an interest rate perspective, there's no difference. From a fee perspective, there may be. It's typically fairly nominal.
And what would is there any difference in the term of the loan between the two types of structures?
Yeah, no. So again, Bangor Savings Bank is considered what they call a preferred lender. So we are structuring our deals based right off of our typical rate sheet. So a customer that comes in and sits down and needs an SBA loan versus a customer that does not, they're getting the same interest rate, the same term. Okay. It's essentially an identical loan from your perspective as a customer. You wouldn't know the difference other than with a little bit of paperwork.
And what is a typical commercial loan term? How many years?
It depends. So if we're talking real estate, I do like to go no more than 20 years. If you're looking at like just a regular term loan, what I try to do is I try to ask you as the expert, how long is this thing going to last? So I'm buying a tractor today. Okay, well, how long is that tractor going to be in service for whatever it is you're doing? And I try to make sure that whatever loan term I'm offering you is not outliving the useful life of whatever it is that you're buying with it. Because it doesn't do anybody any good to keep paying on something at the end of the day if it's not in use anymore. That doesn't do you any good, and it certainly doesn't do me any good from a collateral perspective.
Thank you.
You're welcome.
We had another question pop in the chat, said, you have not mentioned the business credit scores of the companies. For example, DUMS Paydex, Experian. Is this really important?
I did briefly mention it. We do not use them. You are going to find that those are typically very large companies that generate a business credit score. And they are typically associated with very, very large banks that would utilize that type of credit score. So for any community banks, or really any of the banks that we have a presence in Maine, I think you're going to find that's not something that's used.
Right.
Nicole, you've just done a great job. I think it's always like mysterious about what banks do when you when you come in for a loan and how it all works. And one of the things I really appreciate is kind of how transparent you were about the process, and also kind of getting us familiar with some of the terms and what you look at. Really, really appreciate it. Well done.
It's not nearly as scary when you get a little peek behind the curtain.
Yeah, thank you, Nicole. And as mentioned, we'll be sending out Nicole's slides. We'll be sending out a recording of the presentation, links to any additional resources that Nicole wants to share. So stay tuned to your emails for that, either later today or tomorrow. And if you have any other questions, feel free to follow up with us here at the library, or follow up directly with Nicole or with Donna for SCORE questions. Thanks everybody for coming today.
Anna, do you want to
Thank
talk
you so
about
much.
our next month's?
Oh, yes. Thank you for the reminder. So we do have our next library and SCORE workshop scheduled, which is going to be Wednesday, February 14th. We'll have a very romantic discussion of how AI can improve your business. So if you are interested in attending that, I'll include the link to register for that in the follow-up email. But that should prove to be another fun and interesting discussion.
Thank you, Donna. Nice job.
Thank you.
Thanks everybody for coming.
Thanks,
Have a great
everyone.
day.